I'm Jeff Zimmerman, CEO of Fortin Home, and welcome back to Builder's View. Today we're talking about a concept you're hearing more often in real estate and private investing, which is private debt. Most investors know what it means to own a property or buy equity. Far fewer fully understand how private real estate lending works, and why many investors today, especially in volatile markets, use it for contractual, collateral-backed income. In this episode, we're going to break down what private debt actually is and how it differs from equity and traditional bank loans, where it sits on the capital stack, and how it supports real estate projects, including attainable housing. This is an educational episode, not a sales pitch, and not an offer of securities, designed to help you make more informed, confident decisions. Let's start with a simple definition. Private real estate debt is when you are the lender. That could mean you fund the entire loan or participate fractionally alongside other investors through an investment manager like Fortin Home Capital. You provide capital to a real estate project or operating company. In return, you receive a fixed or floating interest rate, a defined term, and a predictable repayment structure, and real estate collateral or hard assets securing your position. You're not buying ownership. You're entering a contract. Lend a specific amount of money, receive a specific rate of interest under specific terms with a specific collateral. These loans are negotiated outside the traditional banking system. You can think of it like holding the mortgage instead of owning the property. Monthly payments show up on a schedule as long as the project performs and the borrower stays on track. Now, how is private debt different from a bank loan or equity? Bank loans are standardized and heavily regulated. They're valuable tools, but they can be inflexible, especially for construction and value-add projects. Equity is ownership. You participate in the upside, but you're also last in line for repayment. If the project underperforms, equity takes a loss first. Private real estate debt sits between the two. Higher priority than equity, more flexible than banks, contractual predictable cash flow rather than performance-based returns. In 2025, private real estate debt strategies have generally targeted high single-digit to low double-digit yields, typically higher than bank deposits or government bonds, while providing steady monthly distributions for investors seeking fixed income. Most investors understand that banks lend at higher rates than they pay you. Here's what happens today. You deposit your money at the bank. The bank pays you around 0.1% to 0.5% on that deposit, the 2025 national average for savings accounts. The same bank turns around and lends that money out on a construction loan at 7.5% to 9.5% for 18 to 36 months. The bank pockets the difference, a spread of roughly 7 to 9 percentage points. Out of that spread, they have to cover branches, compliance, FDIC insurance, marketing, corporate overhead, and after all that, the bank keeps maybe 1.5 to 2.5% net. Now here's what private real estate debt changes. Instead of your money sitting in the savings account earning 0.4%, you as the accredited investor can participate directly in the loan, either individually or through a pooled offering managed by an investment firm. The builder still pays roughly 8% to 12%, but now you capture most of the return directly, minus a modest servicing fee that's a fraction of the bank's overhead. Same project, same collateral, same type of loan. You're simply sitting on the bank side of the table, without the marble lobby and the regulatory overhead. That's why private real estate debt can deliver 7 to 12% contractual yields, while a savings account pays pennies. Banks have been making billions on these spreads for decades. Private debt simply lets investors participate in part of the market that historically was not available to them. A core feature of private real estate debt is collateral. Collateral is the asset that secures the loan, what the lender has to claim if the borrower cannot repay. This could include land, buildings, improvements, and sometimes inventory or equipment. Collateral doesn't eliminate risk, but it changes the type of risk, from unsecured credit exposure to a real estate asset-backed position. That's why investors focus on loan-to-value ratios, location, sponsor strength, and the plan for construction, leasing, refinancing, or sale. Those details determine how much protection the collateral provides. To understand risk and return, you need to understand the capital stack. At the top is senior debt. Below that, mezzanine or second position debt. At the bottom is equity. Private real estate debt sits in the priority position. Debt gets paid before equity. Debt is governed by a contract. Equity absorbs losses first. Investors typically trade equity's unlimited upside for debt's predictable contractual return and higher priority. Private debt often provides the capital that gets housing built. It can finance land acquisition, horizontal and vertical construction, factory production, bridge periods, and stabilization through lease-up. Banks can be slower to move on uncertain markets. Private lenders can underwrite the collateral, the project economics, and the operator's track record, and structure the loan that keeps the development moving. It's often the difference between the project staying on a spreadsheet and a project turning into homes for real families. Private real estate debt plays a clear role. Fixed income with real estate asset backing. It can provide predictable contractual income, diversification from public market volatility, higher priority in the capital stack, exposure to real estate assets without owning or operating them. The risks are real. Projects can underperform, borrowers can default, collateral can lose value, but many investors blend private debt with equities, treasuries, and other holdings to build a more balanced risk-return profile. Private debt isn't a replacement for a plan. It's one of the components of a disciplined strategy. Before allocating private debt, investors often ask, time horizon, can I commit capital for a full term? Income needs, am I looking for predictable distributions? Risk tolerance, how do I feel about project-based risk versus market-based volatility? Do I clearly understand the loan, the collateral, and the repayment structure? And alignment, do I want my capital supporting real, tangible housing projects? These aren't recommendations. They're a framework for better thinking. Private real estate debt isn't new, but it's getting renewed attention. As investors look for contractual, collateral-backed income at a time when public markets can swing dramatically on headlines. In this episode, we covered what private debt is, how it differs from banks and equity, how the bank spread works, where it sits in the capital stack, and how it helps build real housing in the real world. If you'd like to go deeper, you can explore more free education resources on private debt and real estate capital on our website. This content is for educational purposes only and is not an offer to sell or solicitation to buy securities. I'm Jeff Zimmerman, and this is Builder's View, where we break down how real estate actually works so you can make better informed decisions.